The next session is to do with asset liability management in the context of Islamic finance. And surely don't look at this as something that's a little bit dry, for it's actually a very topical and important subject. Very soon, as we know, we'll have a great number, a fair number of Islamic banks coming into the country. And liability side, of course, is a well-established and something that people know how to do. But the challenge, I think, not to preempt the next session, will be finding applicable assets to put on the other side of the balance sheet, things that are in the local currency, things that are in US dollar, things that are short-term, things that are long-term. It can be very often a challenge, especially for new banks, to find the appropriate assets for their banks. So with that, let me introduce our new friend, Mr. Ehab Hashish, the project manager, Islamic banking from the National Bank of Oman. If you could come up to the stage, as well perhaps as the two other panelists, and then I will hand it off to Ehab to introduce them. So please join me in welcoming Mr. Ehab Hashish.
Thank you very much, Mark, for giving me the opportunity to moderate this session. The assets and the liability management of an Islamic bank is a very important topic. It has its implication on the balance sheet of the bank, and we all know that liquidity management is a topic of high importance. The aim of this session is to look to the challenges and to the rewards for this kind of business unit, and how to mitigate the risks and to get the best benefit out of such a business unit. We'll begin the session by asking Mr. Mohamad Harris, who is the head of the Islamic banking unit in Bank Sohar, with the kind of the question regarding the prudential limits covering the Islamic banking set by the Central Bank of Oman for the liquidity management and its impact on the different Islamic banks in Oman in the initial stage.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم. Ehab, thanks for that question. And before I answer that question, I would like to thank the organizers and the sponsors for arranging this conference. It's a very important topic, Islamic finance. As we all know, that Islamic banking is about to enter Oman very soon, inshallah. And within Islamic finance, Islamic banking, liquidity management is a very important topic, which is the topic of this session. Liquidity management, as we would be all aware, is a crucial part of the overall risk management framework of any bank, and failure to address this properly may lead to the instability of the bank and other dire consequences. In terms of Islamic finance institutions, the issue of liquidity management becomes even more important because there is lack of developed money markets in most jurisdictions. Now, coming back to the question of prudential regulations that have been advised by Central Bank, what I would like to share is that Central Bank of Oman came up with draft rules for Islamic banks, which they call Islamic Banking Regulatory Framework, or in short, IBRF. The last draft that came was in April this year. And what I did was that I did a review of the chapter. There's a whole chapter on liquidity management, chapter 9. I did a review, and then I noted some salient features that for the interest of benefit of the participants here. Now, more or less, the regulations which are there for conventional banks, they are the same for Islamic banks, except that the contracts that the Islamic banks or Islamic windows need to enter need to be Sharia compliant. Similarly, there are certain ratios which are prescribed for conventional banks. They are the same ratios for Islamic financial institutions as well. When I say Islamic financial institutions or IFIs, I mean both Islamic banks as well as Islamic windows. Now, similarly, the liquidity management policies for a bank or IFI should include both qualitative and quantitative factors. Quantitative factors include, for example, diversity and sources of funds, concentration of funding base, availability of standby lines, etc. And similarly, qualitative factors include treasury management skills, MIS, willingness of shareholders to provide additional funds, etc. Now, areas where IBRF rules are different or specific for IFIs in Oman are that Islamic banks and windows can receive funds for conventional banks, and in case of Islamic windows, they can receive funds from conventional parents also, but these contracts should be Sharia compliant. These contracts should be approved by the Sharia boards with the structures, and they should also address key Sharia issues such as commingling of funds and how would the return be paid to the conventional bank on these placements of funds with Islamic financial institutions. So conventional banks, parents, they can enter into internal agreements to provide emergency funds to Islamic windows. And there are 3 or 4 modes of placements from the parent bank to Islamic windows are prescribed in the rules. One is permanent capital increase by the parent bank into the Islamic window. Another is interest-free loan that a parent bank can give to the Islamic window. Then there could be musharaka or mudaraba-based funding for a specified period of not more than 6 months. In terms of placement of funds, what the rules allow is for IFIs to place funds with Islamic banks and Islamic windows only. It, as a general rule, disallows placement of funds by Islamic banks and Islamic windows with conventional banks, whether it's a third-party bank or it's a parent bank for Islamic window. And in line with that, the central bank has also disallowed the use of commodity murabaha or tawarruk, as we call it, in placing funds with conventional banks. In terms of its impact on IFIs in Oman, well, all the IFIs have to comply with these rules, same rules in terms of ratios, the monitoring and mitigation of risks which relate to liquidity management. The rules are comprehensive. They deal with placement, they deal with borrowing, etc. However, what we need to see is how these rules relate to the scenario that's going to unveil very soon when Islamic banks start, or Islamic windows start their operation, when they are going to be liquid, and they would be looking for avenues to invest their excess liquidity in Sharia compliant assets, because the prudential regulations don't allow placement of funds with conventional banks.
Allow me also to introduce Mr. Muzaffar Hisham, the Chief Executive Officer of Maybank Islamic in Malaysia. And he will give us an idea about the Sharia compliant instruments that will be available, that are available in Islamic banks.
Bismillahirrahmanirrahim. Assalamu alaikum wa rahmatullahi wa barakatuh. Once again, thank you for the organizers for giving me this opportunity to share in this beautiful city of Muscat. Regard to the question of liquidity management, I agree with Brother Haris. This is the most pivotal, important part of risk management, especially on the asset and liability management, and particularly now, most countries are gearing itself towards Basel III. I think when we talk about the context of liquidity, we got to be mindful whether it's a question of excess liquidity or short-term liquidity, and also the question regarding what we call gapping as well. I won't go too much into detail on that basis, but at the moment, what we are blessed is with the central bank in Bank Negara has various types of instruments that able to, particularly the short-term liquidity or excess liquidity to buy its notes in various form of contract. As mentioned earlier this morning in the panel on the capital market as well, we're also pretty blessed after the 97-98 crisis. We have a huge, deep bond or sukuk market as well in the ringgit space, and that has helped also to invest and also trade the papers from AAA to all the way to the various rating as well. Before I pass the mic as well to the master, Brother Ehab. I just like to highlight as well. I think, and I hope we can have this discussion this afternoon. Asset liability and liquidity management must be robust. Robust, what I mean is, there's no direct one answer. There will be a lot of ratios. There will be a lot of debate in any of ELCO or asset liability committees in the various banks. But the robustness must come in terms of priority. If I were to achieve the certain ratios, what are my profitability going to be impacted? If I were to achieve these certain ratios, what is the general environment of liquidity in the context of either in Oman or in Malaysia? So I hope in our discussion, particularly with the regulators, we do need to have this robustness, because different country has its different types of liquidity, and I will later share some experiences on what we have in Malaysia particularly as well. Thank you.
Muzaffar. Now the next question is regarding what we feel is that there are two main issues for the Oman Islamic banking in managing their liquidity, especially in the short term. One is the lack of developed money market systems, and the other one is the shortage of short-term or highly tradable investments in the market, mainly sukuk and other types. What are the alternatives for the Omani Islamic banks to overcome these issues? That question is from Mr. Mohamad Haris.
Okay, I would like to answer this question by sharing my experience in two different banks where I worked before. Both those banks happen to be the first Islamic banks in their own countries. The first one was Mizan Bank. I think we heard about it from another senior colleague of mine in the earlier session. It was the first Islamic bank that was set up in Pakistan. That was in year 2000. And both these banks, and the other one was Gulf African Bank in Kenya, which was set up in 2008. And both these banks went through difficult stages in terms of Islamic money markets and liquidity management. And I think we can relate to that experience in Oman and try to learn lessons from them as to how those banks were able to, to pass that initial stage and be able to then become profitable. So in terms of Pakistan, Mizan Bank, it started in year 2000, where there were very few models available worldwide. There was Malaysian model, there was Bahraini model. The moment we initiated a dialogue with the State Bank of Pakistan in terms of issuance of some kind of Sharia compliant instrument. But there were regulatory, fiscal, legal challenges, and that instrument could not come about for the next 3, 4, 5 years. So in the absence of such money market instrument, what the bank did was that it aggressively booked assets with large corporates. It kept its excess liquidity with central bank at nil margin, but at the same time, it went aggressively into the market and booked large corporate assets so that it could deploy the paid-up capital as well as the deposits it was mobilizing in a quick period of time. As a result, it was able to achieve advance to deposit ratio of about 60-65%, and the remaining was left at central bank at nil return. Of course, it had some impact on the profitability. And like in Oman, commodity murabah was not allowed in Pakistan. It was not the central bank that came up with this rule, but it was the Sharia board of the bank that initially did not allow the use of commodity murabah, using which the bank could have placed funds with conventional banks and could have made profit on that 35 to 40% of liquidity that it was sitting on, which was in central bank earning zero return. But we were challenged in distributing comparative rate of returns to our depositors as well as our shareholders. We engaged our Sharia board, and then in year 2, they were able to understand what challenges the bank was going through in terms of offering competitive market-based rates to the depositors, and they allowed the use of commodity murabaha for the bank on a conditional basis. The conditions were that one, each and every commodity murabaha transaction has to be done in strict compliance with Sharia process flow, approved process flow, and that it has to be supervised by the Sharia department of the bank. And second condition was that as soon as other Islamic money market instruments are offered in the market, then this approval will be phased out and the Islamic banks will not be allowed to use commodity murabha to place fund with conventional banks. Same was the case in Kenya, where central bank did not have any rule against commodity murabha, but the Sharia board of the bank did not allow commodity murabha for the bank to be entered into to place fund with conventional banks. The bank again followed the same strategy to go out and book as many large corporate assets as possible to deploy its capital and the deposits into yielding assets. At the same time, it had to keep itself liquid to meet unforeseen needs, because there was no discounting window available to them from central bank. So as a result, again, their profitability also suffered. And in fact, being an Islamic bank in a non-Muslim country, the issue was that if we were not able to offer attractive returns to our depositors, it was raising questions on the viability of not only the Gulf African Bank, but on Islamic banking industry as a whole. So the Sharia board took notice of this, and they then allowed, again, the conditional use of commodity murabha to be entered into to place funds with conventional banks. And the conditions were more or less the same, that strict supervision of the Sharia department for each and every transaction. And secondly, as soon as other instruments or Islamic windows come about in that region, in that country, then preference should be given to placement of excess liquidity with Islamic windows and Islamic banks. Now, in terms of what Omani banks, Islamic banks can learn from this, is that one, they have to continue to work with the central bank, with Capital Markets Authority on this issuance of sukuk. It's not an easy process. It's going to take time, and it requires all the stakeholders to join hands to come up with the issuance of sukuk. Secondly, as per the draft rules that are available, they would have to go out and book assets quickly. The issue is that there is a difference between Pakistan and Kenya model and Omani model. In Pakistan and Kenya, these were the only Islamic banks, one or two Islamic banks which were working in the market at that time, so they had the entire space available for them to book corporate assets. In Oman, we have two full-fledged Islamic banks coming up. We have 4 or 5 windows that are coming up, and they are all coming up at the same time. So they'll be hungry for booking large corporate assets, retail assets at the same time. We all know that Oman is already a liquid market. The rates are already going down. So the entrance of these Islamic windows, Islamic banks, is going to put a lot of pressure on interest rates further downward, and these banks would have to work closely, seriously with central bank and other stakeholders to try to come up with instruments like sukuk. And third thing is that they would have to keep the balance excess cash with the central bank at nil return. So that is how I see the initial stages of Islamic banking in Oman.
Mohamad. Now, we need to know the experience of the other countries that had experience in Islamic banking, especially a country like Malaysia. And the question is to Brother Muzaffar on what are the lessons learned from a country like Malaysia in managing its liquidity.
In Malaysia, the last few years, we have a bit of a reverse. Rather than excess liquidity, we have in the Islamic banking in general, we have what we call the rate of return banking book, or the gapping issue. Over the last 15 years or so, a lot of assets in Islamic bank has been fixed rate for a long tenor. So if we look in terms of the overall gapping, excuse me if I sound a bit technical here, the VAR, so to speak, there is short-term funds, but funding for the long-term assets. That was the challenge over the last 5-6 years in most of the Islamic banks in Malaysia. So therefore, there was a lot of emphasis of what we call chasing for the sticky deposits. That means the retail deposits or the non-institutionalized deposits. Now, this is one of the greatest challenge for the Islamic banks in Malaysia. Why I say that is because we are a young industry, and a lot of the big deposits, the retail deposits, has been gone to the conventional one. Second, as mentioned by the Prime Minister, former Prime Minister earlier, we're not. There's only 55% also are Muslim, or 60% of population Muslim. And a big chunk of the economy as well by the non-Muslims put a lot of their retail deposits in the in the conventional banks. However, one of the key interesting feature in the liquidity in Malaysia is we have large institutional funds, from the pension funds, the government institution funds, where it's circled, the ringgit market is circled within these banks. So there is always this balance between these sticky retail deposits and these institutional depositors that most Islamic banks need to monitor. In other words, what I'm trying to say is, if there's a possible run, we're quite confident there's not going to be any run, because these funds are basically within the system. So that's something which is a bit thin on the line. However, it's very interesting to see in Oman's case, and we need to understand the challenges on the excess liquidity. And this is where we hope to see the organization like the IILM, the International Islamic Liquidity Management, which we made to understand now they've got a new CEO, came on board, to see how that could be addressed globally in terms of tackling this excess liquidity. But one idea that maybe we may want to think about between central banks, they should allow a certain amount of percentage of portfolio, in my view, to say, for example, if there's excess liquidity here, allowing the Islamic banks in future to maybe look at other central banks that you have confidence in that country or the central bank. For example, country A, country B, country C, I better not mention which country, to allow that cross-border excess liquidity. There may be some effects, foreign exchange risk, but I think for managing short-term, that FX risk can be able to minimize. But just food for thought for discussion. Thank you.
Thank you, Brother Muzaffar. Brother Mohamad, would you like to give us something about your experience in the other countries for the lessons learned?
Sure. First of all, I think it's a very good suggestion that brother has given, Muzaffar has given in terms of placing excess liquidity in offshore banks, especially Malaysia, which is looking for liquidity. We all know that there are certain ratios and limits that are imposed by a central bank prudential regulations in terms of offshore placement. So that's one area that central bank can look at and try to relax in the initial stages, so that IFIs in Oman can place excess funds in other jurisdictions which are safe and attractive also. Now, in terms of, I think Malaysia is a very good example to study, but then one other example that I came across which is quite interesting is Indonesia. Because what I understand is that the National Sharia Supervisory Board of Indonesia also does not allow the use of tawarruk, bayul ina, etc., which are otherwise accepted in other jurisdictions. So then the question comes that how are the IFIs in Indonesia managing their liquidity, and can we learn lessons for Oman from that example? In terms of Indonesia, I think central bank, which is Bank Indonesia, has taken a key role in trying to make it easier for IFIs to manage their liquidity. In year 2000, for example, the Central Bank of Indonesia came up with the Mudarba-based money market instrument, which is now used by all the IFIs for interbank placements. Similarly, the IFIs in Indonesia also have access to Sharia certificates, which are issued by Bank Indonesia. They are called SBIs, or Bank Indonesia Sharia certificates. IFIs can invest excess liquidity in these certificates, and then at the time when they need liquidity, they can repo this back to Bank Indonesia and create or raise liquidity in time of need. So these SBIs or Sharia certificates are acting as money market instrument to mop up excess liquidity in the Islamic money market. So IFIs in Indonesia, they in terms of liquidity management, they are relying on balancing their assets and liabilities, reserving their liquidity for unforeseen needs, and then they have access to these SBIs to invest excess liquidity, as well as to report back to Bank Indonesia if they need liquidity. And over top of this, as a last resort, Bank of Indonesia also offers a Sharia financing facility to these IFIs. It can be intraday, and it can be up to from 1 day to 90 days as well, in which IFIs can go and borrow funds from Bank of Indonesia. Of course, Bank of Indonesia charges some return for it, but for this facility, the IFI has to offer very high and liquid collateral to secure the line. So I believe that that's a very good example that we have, and I think Central Bank of Oman, it will be a very good point for us to study the model in Indonesia and see if we can try to implement some of these measures that Bank Indonesia has done in Oman.
Sorry, just an update for Indonesia. Actually, a few months back, I think the National Sharia Council, they call it Dewan Sharia Nasional, has allowed for commodity murabah, but only interbank at the moment. So they're beginning to look at it, but one of the condition is interbank, and the other one is you got to use the commodity based on their Jakarta bourse. So I suspect, and apologies if there's any Indonesians here, I suspect it's a bit more, you want to use my commodity, use my commodity, not anybody else. Yeah. So I think they're looking at that. Yeah.
Perfect. As Brother Muzaffar said regarding IILM, IILM is the International Islamic Liquidity Management Corporation. It's based in Malaysia with the aim to facilitate cross-border liquidity management among institutions offering Islamic financial services by making available a variety of Sharia-compliant instruments on commercial terms. Now the question is, how can the Omani Islamic financial institutions benefit from such an organization? And the questions will be for both for Brother Muzaffar as well as Mr. Mohamad.
I would like to give the tough question first. No. I think IILM is very much welcome to establish, to help for the liquidity management. But I made to understand, I may be wrong here, and maybe Brother Haris could also vouch this. One of their challenges is in issuing securities backed by the OIC members, because the rating by the rating agency are pretty low. Now, this is the debate that I've always discussed with our team as well. Why do we need to depend on the international rating agencies? If the key OIC members, Malaysia is rated A plus at the moment, or if the other countries in the GCC would be able, not independent from the rating agency, but among the central banks, to just allow a certain percentage in issuing this security, I think that could be very helpful. That means, and you know, the international rating is also not very much perfect as well. So this is what I understand in the market and what I read in the journal. This is not official from IILM, but what I understand is their challenge is coming up with an instrument that is AAA, because the OIC members are not AAA.
Okay, I would like to just add that we have looked at or discussed the various models, and what we'll find is that there's no global solution to it. Pakistan is following its own model, Indonesia has its own model, Malaysia has its own model, Bahrain, UAE, etc. They are all following their own models for money market, for liquidity management. So International Islamic Liquidity Management Corporation was set up in late 2010 in Malaysia, just to make sure that they can come up with, or the industry can come up with, a global solution for liquidity management. In fact, it was set up with the collaboration of 12 regulators of central banks, and some of the countries that are involved as sponsor members: Iran, Malaysia, Indonesia, Kuwait, Qatar, and few other countries, and then Islamic Development Bank Jeddah is also a sponsor member, founding member of this corporation. Most of the industry experts, they believe that the absence of a globally accepted instrument or solution is a major hindrance to the expansion or growth of Islamic finance, and that's why I think as an industry, steps have been taken, bodies have been set up in the last 8-10 years. For example, There's IIFSB, which is a prudential regulation setting body. Similarly, there's IIFM, which is a standard setting body for Islamic capital markets and money markets. Similarly, IILM was set up in late year 2010, so that, because in different jurisdictions there are different interpretation of Sharia fatwas. Although the Sharia fatwa ruling is the same, but it's interpreted in different jurisdictions in a different way. Similarly, different jurisdictions have different accounting standards, documentation, etc. Then you have different legal system, accounting system, regulatory system, which does not allow for a globally accepted solution. And that's why IILM has been working towards that, and they have been working trying to issue the first sukuk, which is globally accepted, but it's taking time. And the reason is because that sukuk or the instrument has to meet the standards and the laws of all 12 founding countries, and it's proving to be difficult. But we hope that they will come up with this instrument very soon. And in terms of what Oman can benefit from IILM, I think my view is that Oman could consider becoming a member of IILM, so that whenever a new instrument is being structured, Omani laws can also be looked into and make sure that that instrument complies with Omani laws, so that then IFIs based in Oman, they can invest in those instruments for managing their liquidity.
Very much, Brother Mohamad and Brother Muzaffar. Now, we heard from Brother Muzaffar regarding the Islamic banking in Malaysia, and the fact that the liquidity in the beginning was very high in Malaysia. However, over the years, there has been a shift, and there has been some gapping and a tender mismatch in their liquidity. As well as we heard from Brother Mohamad regarding his experience in Kenya and in Pakistan, regarding the setting of new banks, where setting new Islamic banks, where the Islamic banks had to rush to book a lot of corporate assets, which impacted on the profitability as well as the liquidity of these banks. Now, the question is, from your point of view, what are the recommendations and suggestions for a robust liquidity management system that can address all the risks and get most of the rewards? And the question is for both as well, for Brother Muzaffar as well as Brother Mohamad.
Okay, I'll go first this time. Okay, I would, in terms of suggestions and recommendations for Omani Islamic banking industry, I would like to break them into two phases. The first phase would be the short-term phase, or the first, let's say, 12 to 24 months of the industry, and then the second phase would relate to the later years beyond 12 to 24 months. My view is that in the first phase, when the Islamic banks and Islamic windows are starting their operations in a new country, these IFIs should be allowed to use commodity murabha. We have seen it in other countries happening. We have seen Pakistan, Kenya, Indonesia also, which did not allow earlier, but now they allow. I know that there are valid reasons for not allowing it currently in the draft rules. We all know that there were certain, a few years back, banks were entering into these transactions, and there were a lot of eyebrows that were raised because some of these transactions were paper transactions without any underlying trade transactions. Banks were not vigilant in making sure that those transactions were complying to the Sharia guidelines. But then lately, what we have seen is that many Sharia boards and scholars have taken a very strict view on this. They have made sure that the monitoring procedures in their respective banks are strengthened. Many scholars, in fact, have gone to visit brokers at the London Metal Exchange to meet with them, to go and inspect, physically verify the presence of those metals, which are the subject matter of these tawarruk or commodity murabha transactions. They have looked at them, and then they reported back that yes, if these brokers are involved, certain selected brokers, then we can be certain that there will be actual trade underlying those tawarruk transactions or commodity murabha transactions. Similarly, we now have, as a brother has said, Bursa Suqul Salah in Malaysia. The entire purpose of that platform, trading platform, it was set up to facilitate commodity murabha for Islamic banks. So I feel that given the comfort that we have now of Sharia scholars going there, visiting, verifying, and that there are brokers at London Metal Exchange which are actually doing actual trades, and then of Suqul Sila in Malaysia, I think it should be allowed on a conditional basis in Oman. CBO should reconsider its position on allowing commodity murabha for IFIs. And in the meantime, the CBO, Capital Markets Authority, and stakeholders, they need to keep working on coming up with developing sukuk so that IFIs can then start investing, phasing out the commodity murabhas, and they can start investing in sukuk. Similarly, I think CBO also needs to study some of the certificates that are being issued by Bank Indonesia in Indonesian market and see if those kind of Sharia certificates or financing facilities could be offered to the IFIs in Oman. I think that will go a long way in helping or assisting the Omani OIFIs in managing their liquidity effectively. Now, in terms of the second phase, which will be after this, after first 12, 24 months, I feel a number of models are available, and all models are working properly in their own jurisdictions. There's a need for all stakeholders in Oman to study these models and then look at the ground realities and then come up with own model, which could be a combination of one of these models. What I would suggest is that a task force should be set up, which includes all the stakeholders from central bank, from Capital Markets Authority, from IFIs, who need to look at all these models. I can recall that in year 2004, State Bank of Pakistan, we were going through the same problems. Then eventually State Bank of Pakistan set up a task force which was called Task Force on Liquidity Management for Islamic Banks. And that task force met for about 4 to 6 months. They looked at different money market instruments, different models, and then they gave their findings in the form of a report. That report eventually became the basis of the sukuk, ijara sukuk, that were issued by government of Pakistan in the later years, which made it very easy, not very easy, but it made it easy for the IFIs in Pakistan to manage their liquidity. So I feel that that task force needs to be formed, which needs to look at all the models very closely and then adopt something which makes sense for Oman as a country. And kind of work that we have, I think we have got a lot to do as stakeholders and not a single minute to lose.
Well, recommendation is going to be, there's a lot of things that we can look at. But I'd like to go on 3 areas here. First and foremost, I think I strongly urge all countries, I think, to get ready for Basel III now. I know it's a very hot topic, a very complicated topic as well. This is the direction globally that most banks are going to. And the beauty of it in Islamic banking, if we study really on the Basel III requirements, on the various ratios and so forth, there are certain advantages in Sharia or in Islamic banking that could be benefit to the industry. Well, that's another topic altogether. But in various discussions with the regulators and with the risk team, the devils are in the details. So that is one of my strongest recommendations. We really need to deep dive into this Basel III. When we talk about Basel III as well, and do also open up and encourage all the way from the board, senior management, risk, product, to really understand liquidity management. Because one of the challenges that we have, Maybank, Islamic particularly, we manage about 26 billion worth US dollar of asset at the moment. In the first few years, early years, can get quite frustrated because when the product guys comes up with some campaigns or a product, it doesn't jive with the asset liability management strategy of the bank. And sometimes when we try to talk about various asset liability management, as you know, our board, sometimes in any of the bank's board, a diverse set of people, bankers, ex-government civil service and so forth. So we need to get everybody on board to really understand this because as you know, in the last 2008, 2009, post-Lehman and Bear Stearns, this is one of the biggest hole in the bank that needs to be mindful about. So one of the big steps that all of us need to do is to look at the Basel III. Second point is on liquidity, and among the Muslim countries, or do encourage, I believe, in cross-border liquidity. I give one best example, and I apologize if I sound a bit straight here. Saudi, when we start to look at their funding to deposit ratios, and I think most GCC as well, has a low FDR, or funding to deposit ratios. Saudi alone is about 35% in their banking. Each time there's a dollar sukuk going to the market, it's always a premium price. And what we found out is there's a certain tight regulation, of course, by the authorities, not to allow for the banks to invest or the pension funds to invest abroad. Now, we can understand there must be some protectionism because that protects the investors. But there must be a free flow, a certain percentage, because that will create the robustness, particularly in the dollar liquidity, I believe. We've seen that quite successfully between Malaysia, Singapore, and Indonesia. But I'm very confident if the protectionism is not there, the enhancement of the cross-border liquidity will be more improved. Last but not least, in the Islamic space, the development of restricted mudarabah, or I think some of you may be aware, the mudarabah muqayyadah back-to-back. I'm beginning to see more and more Islamic banks looking at this, matching their gapping together with the investors' needs. This is something interesting, but Islamic banks need to be very mindful about the type of disclosure to the investors. They must be very clear. We've seen certain institutions say, yep, you put in mudarabah, but I'm not going to tell you what I'm going to invest. That's very dangerous. I strongly believe in a full disclosure regime by the various securities commission in various certain jurisdictions. There must be a clear disclosure requirement, particularly on cases of mudarabah muqayyadah or restricted mudarabah. So I would like to just tackle on these 3 points later on. Thank you very much.
Thank you very much, Brother Muzaffar and Brother Mohamad. Now we'll open the door for questions from the audience.
Bismillah ar-Rahman ar-Rahim. Thank you all for this, very important, coverage on this very specifically challenging point for the startup of the Islamic banking. We have 2 issues here. We have the short-term liquidity and the long-term, that is the shortage and the access. For the access liquidity, we know that Mudaraba will take care of the issue, which is relatively uncomplicated in terms of Sharia. But the short term and the deficit in liquidity, has the Central Bank of Oman given any guidance on the commodity murabaha or tawarruq? Is it allowed? Is it going to be allowed? Is it going to be up to each bank with its Sharia board to look at it and approve it? So that is one important issue in short term. And what is the current guideline as in hand now? What does it say? Also, I don't see any licensed finance companies in Oman, and that also has a lot of limitations. So the limitation is only between Islamic windows and Islamic banks to work together without any retail outlets. So is that an issue? Do you think we should recommend to the Central Bank of Oman to also look into licensing Islamic financing companies? Just to elaborate on these 2 points. Thank you.
A very good question. I would like Brother Mohamad Harris to answer this.
Okay, as I try to cover in answer to one of the questions, I mentioned some of the salient features of the draft rules that have come out from Central Bank. As things stand right now, we understand from those draft rules that placement with commercial banks using commodity murabah or tawarruq is not allowed, although it also says that on exceptional basis, CBO may consider it on case-to-case basis. So that is the situation in terms of commodity muraba, use of commodity muraba. However, if you look at various examples of different countries, initially that was the case in many countries where either the Sharia boards or the central banks did not allow, but then later on they realized the challenges that these IFIs were going through in the early part of their life, and then they realized, and then they became flexible. I understand that at different platforms and forums, Islamic bankers have been raising this and I think suggesting to CBO for reconsideration on this. I'm sure the central bank must have taken note of it, and we will we'll wait to hear and to receive the final rules as they come out. In terms of answering the second question about whether the CBO should regulate licensed finance companies, I don't know whether I can answer that question, but CBO, central banks are usually bodies that regulate banks only. They don't typically regulate the financing companies. I think financing companies may come under capital markets authority or some other body. They are under CBO? Okay. Then in that case, I think in order to have a level playing field, then if there are some limitation restrictions placed on IFIs, then similar kind of limitations should also be there for other entities that are being regulated by the same regulator. That will be my view on it.
Me also to add that the Central Bank of Oman in their regulation have clearly mentioned that the usance of tawarruq is prohibited, and the only way to use tawarruq is in case of a full conversion of a conventional bank to an Islamic bank. So tawarruq as we speak right now is not allowed. Maybe going forward, as we have just heard that Indonesia has allowed tawarruq for Islamic banks to manage its liquidity. But there has been a between the Islamic banking group in Oman, the Islamic banks have created a forum where they have shared a sort of a wakala investment form to manage the liquidity between the Islamic banks, where there will be a wakala investment, master wakala investment form that will be created between all the banks and signed between all the banks to manage the liquidity. I hope that answers the question.
Sorry, just to ask the question, you're saying finance companies, excuse me, in Oman, is there finance companies more for housing or for auto finance?
For mainly assets.
Mainly assets.
Assets in terms of car leasing.
Just to share, in Malaysia in 97, 98, we have also quite a big chunk of finance companies on, particularly looking at auto finance.
Exactly.
And they were not well capitalized, and this is one of the first few institutions that got hit quite badly when the crisis came. And what happened was the banks absorbed it as well. So I think your question was quite precise as well. They can create assets, but need to be careful if it's also, are they well capitalized. But maybe just a point as well, and I don't know, maybe Oman may want to think about this as well. In Malaysia, we also quite blessed. We had an institution called Chagamas, and also government staff housing loans or financing, where the civil service staff housing loans or financing, they collateralize it, and they came up with various standards of instrument. So this is another type of instrument that the banks could subscribe it, and they have some comfort that they're given a certain liquidity classes to allow it. So as a country that need housing, just like us in Malaysia as well, and certain countries as well, this could serve both ways. You have the housing, and you also serve certain amount of liquidity to the industry.
Thank you very much. Any other questions?
Thank you. Everyone knows that actually one of the key success factors for Malaysia in terms of Islamic banking was their progressive approach towards Sharia, and particularly on the sukuk market. Now the problem that we see, particularly in the MENA region, is that most of the development is done around the commodity murabaha or around tawarruq, despite the sort of controversial issue that we are seeing from even some Sharia scholars regarding the usage of tawarruq, for instance. So my question is actually to the to both honorable speakers. Don't you think that too many people are focusing systematically on product development around that pillar, which is the commodity murabaha, and not too much effort is actually given towards other areas? I mean, we've heard today about the risk management, Basel III, etc. But unfortunately, I haven't heard anything related to, for instance, hedging, which is a key pillar in asset and liability management. And I think we've seen the crisis, for instance, in the region where actually most of the banks failed even in managing a basic matching between assets and liabilities. And here we're talking about a massive number of banks in the region. So don't you think that a lot of people are focusing too much on this commodity murabaha issue and they are really missing a lot on the other areas? Thanks.
I think you're right. I think hedging is one of the key parts that we need to really focus on as well. But this is the point. The commodity murabaha or the tower, this is the central part of it. If we can sort that out, the hedging bit on the other instruments can come in. I think that's one a potential solution for other hedging instruments. The other part is, and again, if I may sound a bit too direct here, there must be a very clear which is the Sharia regulation or regulatory part that the institution can follow. Should we following the central bank Sharia committee, or should it be the national Sharia committee? Now, this is a very pivotal point. And the best example is Indonesia. They use the national Sharia committee, and it's sometimes not aligned with the central bank of Bank Indonesia. That can make it a bit tricky. For players like us, we do need to have what is that body that gives the central green light, and that makes it a bit easier for us to move forward in the product development, both hedging and so forth.
I would just like to add that the reason that we are hearing about commodity murabaha or tawarruk here is because Islamic banking industry in Oman is in a stage where it needs this product. Otherwise, if you have the same forum in Malaysia or in Pakistan, they will not be talking about commodity murabaha or tawarruk because they are past that stage. They have other money market instruments available. You will find that people will talk about ijara, istisna, salam, and many other complicated variants of these modes. So there is reason that in Oman you may feel that we are focusing on commodity murabaha, but in terms of other aspects of liquidity management, like you said, hedging and other things, of course, in terms of maturity of assets and matching of assets and liabilities, there are ratios that have been subscribed in prudential regulations, and they are as applicable on Islamic finance institutions as they are applicable on conventional banks. So the kind of the prudent policies that conventional banks have to adopt, the same Islamic financial institutions have to adopt also, although in terms of hedging, the products will be lesser in Islamic banking than in conventional banking.
Bismillahir Rahmanir Rahim. My question is to Brother Mohamad. I just want to find out that it is basically related to capital structure of a bank or to improve the liquidity of a bank. Is there any viability for an Islamic bank? Because when we discuss about Islamic bank, it's different from traditional banks. So is there any viability for an Islamic bank to jump into a business? For example, to a bank, a cement company comes for the loan, and the bank jumps into the business and then play their part as a partner. And due to that, definitely they can improve the liquidity and they can improve the capital structure. But is there any viability of that? My question is this. Thank you.
You mean viability for the company that's being invested into?
The bank, for the bank.
Yeah, for Islamic bank, for example, they can invest in a company, as you mentioned, cement company, and there are different modes of investment. There could be a debt-based structure, and there could be equity-based structure. Debt-based structure could be a JARA structure if a company is trying to raise financing for machinery, And it could be a murabha also if it's buying raw material. In case of equity-based investment, it could be musharaka or mudaraba. And all these have different features with them. And for the bank, whether it's entering into a debt-based transaction or equity-based transaction, they are viable as long as they are structured in a way that it is beneficial for the bank as well as for the company itself.
Are the banks doing these transactions here in Oman?
No bank is doing it in Oman because Islamic banking has not started here. But I am very confident that the moment Islamic banking starts, you will see banks entering into murabha transactions, mudarba transactions, ijara transactions, salam transactions, istisna transactions. All these windows and banks, they are working. I'm sure that they have finalized their products, and inshallah, I think the customers are going to be pleasantly surprised with the range of products that will be offered by Islamic finance industry to Omani, different segments of Oman.
So if I may just add, this is where the disclosure part must come in very important. We shouldn't take for granted Islamic banks can go into the equity using the depositors' funds. I think this is the part where risk management must come into very clearly. If there is some equity partner and some private equity, then it must be very clear this is which is the source of funds, and there must be a certain level of commitment from capital from the bank itself. Because we've seen some transaction where the separation between the deposits and investments in equity can be quite dangerous as well.
Excuse me. I have a question to Mr. Mohamad. I believe you have done much research and you have checked with central bank in terms of liquidity, since we are talking about the assets and liability. And the presenter was asking you a question related to the short term. And during the short term, how the banks will manage their liquidity. But you gave us two examples. One example was the Kenyan example and the Pakistani example. But in between, you said in 2004 that you guys approached Central Bank of Pakistan to come up with some kind of sukuk instrument to reduce the liquidity from the market. But what I discovered from your session, that your presentation, what you said now, it instead of you talked about the short-term coverage, you went to the long-term. But what are the short-term resources that to be what you call local banks or the Islamic bank has to do to manage their liquidity? Can you just cover some points?
Okay.
How the local banks can, or Islamic banks, manage their liquidity?
Okay, fine. What I mentioned when I was sharing the example of Pakistan, that in the absence of sukuk or money market instrument, what this bank did was that it went out in the market and booked assets aggressively, corporate assets, large assets, so that it could deploy its capital as well as deposits in a quicker amount of period of time. And that is what, in view of the regulations that are coming out, the draft that we have seen with the placement with conventional banks not allowed, and so many banks coming up with paid-up capital. In fact, what we are looking at is injection of about $1 billion in terms of paid-up capital only for these two full-fledged Islamic banks as well as the Islamic windows. So all these banks, without having the allowance or the avenue of placing with conventional banks, they would have to either keep that in central bank at nil return, or they would have to place with offshore Islamic finance institutions subject to limits that are prescribed by CBO, which are not very high, or they need to go out and book assets in corporate segment, in SME segment, in retail segment, which may take time and which will put downward pressure on the interest rates. But and then they could also go and plead with the central bank to allow them exceptional use of commodity murabha. But based on the draft rules that are available, these are the options that seem to be available to IFIs in Oman in the initial stages.
So let me say one thing, that there is no out in short term, you mean, initial stage.
These are the options that I see available right now, unless, as I said, that CBO allows some bigger amount to be placed offshore. Then we can look at Malaysian market, buy some sukuk or instrument.
But we are talking again here cross-border, where there is an exchange involved. So here again the spread is huge. We are talking like 100 basis points. And plus, if you are talking, if you see here, the limited banks are available here. within those 5-6 banks, or some 2 Islamic or 3 Islamic banks, full-fledged, and some window banking. So with those small institute or small market, we cannot deploy our money in short term. It will take us like stages, like you say, it takes us another 5 years. Or is it possible that within 1 year or 2 years we can manage our liquidity in better way?
I'm not sure whether I can put a time frame to it, but what it will also do, I mean, although there is going to be a cost to it and profit margins are going to suffer because of lack of availability of money market instruments, but then it will also force Islamic banks and windows to look at SME sector, which may have been not on the radar of conventional banks. Islamic banks would have to think differently. How do they deploy this liquidity? How do they partner with the industry in terms of corporate, in terms of small to medium enterprises, so that they can deploy assets, and in the process they can also elevate the growth of these sectors which may otherwise not be on the radar of conventional banking industry.
Allow me also to add, between the Islamic banks and the Islamic windows, the central bank has set the rule that the Islamic banks, the full-fledged Islamic banks, has to place capital of at least 100 million riyals, while the Islamic windows, the capital should be at least 10 million riyals. The problem will be mainly for the full-fledged Islamic banks. As for the Islamic windows, 10 million could easily be covered from the converting of the existing loans. You are absolutely right. The problem will be for the full-fledged Islamic banks. But as we had the sessions with all the Islamic banks, as I said before, it was agreed that they will create a standard wakala agreement between all the Islamic banks, where the flow of funds will be done through this wakala. And the Islamic windows will be able to borrow from the full-fledged Islamic banks on a short-term basis as well. Okay. Okay, thank you very much for this. And I would like to thank our speakers, Mr. Muzaffar Hisham, the CEO of MIIFF Malaysia, and Mr. Mohamad Haris, the head of Islamic banking in Bank Sohar, as well as our host, Amani, and the rest of the crew. Thank you.
Well, thank you very much. It was an excellent session. It's always good to have real experts on the subject matter participating in the discussions.